Ladies and gentlemen, let's set the record straight from the very beginning. What I'm about to share isn't rumor, exaggeration, or blind optimism. The future of silver is the unavoidable outcome of decades of reckless monetary policy, unchecked currency creation, and a financial system built on illusion. And when that illusion finally collapses, silver won't just climb. It will be repriced, not by a few percent, but by magnitudes that seem unthinkable today. Right now, silver sits at the crossroads of denial, deception, and deliberate distortion. It is arguably the most manipulated and misvalued asset in existence, not because its fundamentals are weak, but because its price has been severed from reality. What's called the silver market is no true market at all. It's a paper construct designed to mute the monetary signal silver has carried for thousands of years. At its essence, silver is money. It has always been money, long before central banks, fiat currencies, or government guarantees. Its worth comes from scarcity, durability, and universal trust. Yet today, it's treated as if it were nothing more than an expendable industrial input, consumed and discarded, rather than saved and respected. That distortion isn't accidental. It's necessary to preserve confidence in paper currencies that are being eroded daily. The price you see flashing on a trading screen isn't the price of silver. It's the price of leveraged paper contracts shuffled by institutions that neither hold nor intend to deliver the physical metal. For every ounce of real silver, there are dozens, sometimes hundreds, of paper claims. That's not price discovery, it's price suppression. When promises replace supply and leverage replaces demand, the market ceases to function as a market. Think about the absurdity. Governments are drowning in deficits, central banks are monetizing debt at historic levels, and currencies lose purchasing power year after year. In any honest system, silver would already reflect inflation, debasement, and systemic fragility. Instead, it remains pinned down by a derivatives machine built to manage perception. Meanwhile, the fundamentals are undeniable. Silver is consumed in solar panels, electronics, medical technology, and unlike gold, much of it is unrecoverable. At the same time, investors are waking up to the reality that fiat money is a losing bet. Rising demand, shrinking supply, and a stagnant price. That's not a free market, that's a broken one. What makes silver uniquely dangerous to the system is its scale. The silver market is minuscule compared to stocks, bonds, or even gold. It doesn't take much capital to overwhelm supply once confidence in paper claims falters, and when that moment arrives, the repricing won't be slow or orderly. It will be abrupt and chaotic. This is why silver is suppressed more aggressively than almost any other asset. A rising silver price isn't just inconvenient, it's damning. It exposes inflation, monetary mismanagement, and the lie that currencies are reliable stores of value. If silver traded freely, it would reveal just how much purchasing power has evaporated and how fragile the system truly is. Critics dismiss silver as volatile, speculative, or risky. But volatility isn't risk. It's the clash between manipulation and reality. The real risk lies in trusting a currency backed by nothing, printed without limit, and managed by politics over a finite, tangible asset that has preserved value for millennia. The most mispriced assets are always ignored until they become indispensable. Silver has been sidelined so long that manipulation is mistaken for irrelevance, but markets correct, paper promises fail, and when confidence collapses, what was suppressed becomes vital overnight. Silver doesn't need a new narrative, a marketing campaign, or Wall Street's blessing. It only needs honest pricing. That alone would trigger a seismic revaluation. When silver is finally measured in real money rather than depreciating currency units, today's price will look absurd in hindsight. The question isn't whether silver is manipulated. That's obvious. The real question is how long the illusion can endure. History is clear. No system built on distortion lasts forever. When the paper facade crumbles, silver won't just rise, it will reclaim its role, and those who recognize that suppression was opportunity, not danger, will be the ones prepared. So when people scoff at the idea of silver soaring thousands of %, they're not rejecting logic, they're reacting to conditioning. They've been trained to accept distorted prices as reality. Strip away that conditioning, examine the fundamentals, and the conclusion is unavoidable. A dramatic revaluation isn't extreme. It's inevitable, and it begins with the currency itself. Let's talk about the unit silver is measured in today, the fiat currency. That unit has been relentlessly devalued. Over the past few decades, the money supply hasn't just grown, it has exploded. Trillions of new currency units have been conjured out of thin air, backed only by political expediency and government promises. Basic economics tells us that when supply surges like this, value must erode. Official statistics may try to disguise the damage, but the math doesn't change. It only postpones recognition. Now contrast that with silver. Its supply doesn't expand anywhere near the pace of currency creation. Mining output is slow, costly, and often unprofitable at current prices. Much of the world's silver is produced incidentally as a byproduct of other metals, meaning production cannot simply ramp up when demand rises. Meanwhile, industry consumes silver constantly: solar panels, electronics, medical uses, and much of it is permanently lost from above-ground inventories. That's the opposite of fiat money, which multiplies endlessly. Historically, silver has preserved purchasing power. Across centuries, it has bought roughly the same amount of real goods. What changed isn't silver, it's the currency used to measure it. When silver looks cheap, it's not because silver lost value, but because the measuring stick, fiat currency, has been artificially inflated through policy tricks and confidence games. A revaluation would simply restore honesty to that relationship. Consider the gold comparison. For most of monetary history, silver traded at a natural fraction of gold, reflecting scarcity. Today, that ratio is wildly distorted, a product of financial engineering rather than fundamentals. To claim silver cannot rise dramatically is to assume this distortion will last forever, an assumption history has never supported. Ratios don't drift back gently. They snap when confidence breaks. A 7,000% revaluation sounds outrageous only because people anchor to today's manipulated price. But if silver were priced to reflect the true expansion of money supply, real inflation, and its historical role as money, today's price would look laughably low. Multiply silver's current price by the scale of currency debasement, and suddenly the numbers don't look extreme, they look conservative. Critics argue such a move would require unprecedented demand. That misses the point. Revaluations don't hinge on new demand. They happen when artificial supply collapses. The paper-silver market creates the illusion of abundance. Once confidence in those paper claims evaporates, supply vanishes. Sellers realize they don't actually hold what they promised, and price becomes irrelevant. At that moment, silver trades at whatever level clears the market. That's why revaluations are sudden and violent. They don't happen because everyone suddenly decides silver is valuable. They happen because everyone realizes the old price was a lie. The adjustment isn't incremental, it's a reset. A 7,000% move isn't a line on a chart, it's a recalibration of reality. It represents decades of suppressed prices colliding with decades of monetary inflation all at once. The longer suppression continues, the sharper the eventual correction. That's not speculation, it's market physics. The biggest mistake investors make is assuming tomorrow will mirror yesterday. They project recent calm into the future and ignore the structural cracks forming beneath the surface. But markets don't correct when it's convenient. They correct when they must. Silver's current price rests on faith in fiat currencies, trust in financial intermediaries, and belief in the permanence of paper markets. A 7,000% revaluation assumes none of those things. It assumes reality eventually asserts itself. The math is obvious. The only question is whether people recognize it before or after the reset. When silver is finally repriced to reflect real value instead of financial fiction, debate will end. It will be clear the old price was never real. Fiat currency doesn't collapse overnight. It erodes slowly, then fails suddenly. The pattern is always the same. Governments overspend, debt outpaces growth, and central banks fill the gap by printing money. At first, it feels painless. Markets rise, recessions are delayed, politicians claim credit, but that stability is artificial, bought at the cost of purchasing power. What most people miss is that fiat money isn't designed to preserve value, it's designed to circulate. Inflation isn't a bug, it's policy. As money loses value, people are forced to consume, speculate, and take risks just to tread water. Savers are punished. Prudence is penalized, and those closest to the printing press benefit first, while the rest pay later through higher living costs. For a time, fiat systems survive on little more than belief. As long as people trust that the currency will still be accepted tomorrow, the illusion holds. But confidence is fragile. It erodes with every bailout, every emergency program, every promise that another round of money creation will somehow undo the damage of the last. Eventually, reality intrudes. Prices outpace wages, debt becomes unmanageable, and the facade of control begins to fracture. Central banks pretend they can fine-tune inflation and steer economies with precision. That assumption is arrogance. You cannot manipulate the price of money, the most important price in any economy, without unleashing distortions. Bubbles inflate, productive investment shrinks, savings are replaced by debt, and growth becomes dependent on stimulus instead of innovation. Fiat currencies fail for one simple reason. There is no natural limit on their supply. Faced with political pressure or economic pain, governments always choose printing over discipline. Losses are socialized, hard choices postponed, and the currency absorbs the damage. This is where hard assets matter, not as speculation, but as escape. Gold and silver exist outside the system. They cannot be created by decree, they don't rely on promises, and they carry no counterparty risk. They are final settlement in a world built on obligations. Owning something tangible isn't outdated, it's rational. Critics call hard assets inflexible, but what they really mean is that governments need the ability to inflate away their debts. For savers, fiat money is a nightmare. For borrowers, it's a dream. The system is designed to reward debtors at the expense of those who plan ahead. As fiat weakens, the purchasing power of hard assets doesn't rise because they suddenly become more valuable. It rises because the measuring stick is shrinking. When people realize their cash is losing value faster than they can earn it, confidence turns to urgency. That shift happens quickly, and the exit from fiat is never orderly. It comes through rising prices, capital controls, financial repression, and desperate policy maneuvers. By the time governments admit the problem, solutions are already out of reach. Hard assets are not a get-rich-quick scheme. They are protection, insurance against political failure, and monetary irresponsibility. And like all insurance, they are cheapest before the crisis is obvious. The greatest risk isn't volatility in metals. It's trusting a system that requires constant debasement to survive. Fiat depends on confidence. Hard assets depend on reality, and when the two collide, reality wins. The transition away from fiat doesn't need a dramatic announcement. It happens one lost dollar of purchasing power at a time. Those who understand that don't wait for confirmation. They act early, not because they expect chaos tomorrow, but because they know how every fiat experiment in history ends. There is a crucial difference between owning something and betting on it. In distorted markets fueled by easy money and speculation, that difference is blurred. Rising prices make everyone feel brilliant, but when the cycle turns, only real ownership endures. Stackers, those who hold tangible assets outright, are rewarded. Speculators, dependent on leverage and liquidity, are wiped out. Speculators thrive in environments where liquidity drives prices, not fundamentals. Cheap money makes speculation look like skill, leverage magnifies gains, and paper profits create the illusion of wealth. But leverage cuts both ways, and illusions collapse under stress. Stackers operate differently. They don't try to time markets, they step outside them. Holding physical assets without leverage or counterparty risk means independence from daily price swings and insulation from broken promises. In metals markets, this distinction is critical. Most ownership today exists only on paper, futures, ETFs, unallocated accounts. In calm times, that difference seems trivial. In crisis, it becomes everything. Speculators assume liquidity will always be there, exchanges will stay open, and counterparties will perform. History proves otherwise. When confidence breaks, paper markets don't unwind slowly, they seize up. Rules change overnight, margin requirements spike, and those who relied on promises discover too late that only real ownership survives. When trading grinds to a halt and cash settlement replaces delivery, the paper price ceases to matter, because the underlying asset is no longer accessible. Stackers remain unfazed. They already hold what others are scrambling to secure. They aren't forced into liquidation by margin calls, nor are they dependent on clearing houses or promises that may collapse under stress. Their position is real, tangible, and beyond dispute. This is why every monetary reset shifts wealth from speculators to holders of physical assets. Speculators are tethered to the system. Stackers stand outside it. When confidence cracks, those inside rush for exits that no longer exist, while those outside simply watch the repricing unfold. Critics dismiss stacking as outdated, claiming assets should generate yield. But in a distorted system, yield is often just risk disguised as reward. Artificially suppressed interest rates turn yield into a trap, luring investors into exposures they don't fully grasp until it's too late. Stacking isn't about chasing returns in calm times. It's about safeguarding purchasing power when turmoil arrives, and turmoil never announces itself politely. It strikes when confidence evaporates, leverage unwinds, and liquidity vanishes. Speculators cling to continuity, assuming tomorrow will mirror yesterday. Stackers assume disruption, not out of desire, but because history insists upon it. When revaluation comes, it won't honor clever trades or perfect timing. It will reward patience and discipline. Those who endured years of manipulation won't celebrate luck. They'll be vindicated for knowing the difference between price and value. The collapse of speculators isn't moral judgment, it's mechanical inevitability. Leverage fails under volatility. Paper claims fail when delivery is demanded. Systems fail when trust disappears. None of this is personal, it's structural. Stacking is independence. It's a refusal to play a game that demands ever greater risk just to stand still. Speculation bets the game continues. Stacking prepares for when it doesn't, and when that moment arrives, the outcome will be unmistakable. Those who quietly accumulated real assets will see their purchasing power restored. Those who chased returns in a broken system will learn the hard truth. Exposure is not ownership. History may not repeat, but it rhymes, and right now, the rhyme is deafening. When silver is finally repriced to reflect reality, there will be two groups: those who foresaw it, and those left saying, "I should have listened." This is no longer a warning, it's a countdown, and when silver resets, it won't wait for permission. Mark these words.